Welcome to another video tutorial series on fundamental analysis. In this series, we will discuss the use of fundamental analysis in understanding and analyzing the behavior of various financial instruments. To start with, what is fundamental analysis? Fundamental analysis is the technique of analyzing the behavior of a financial instrument based on the various socio-economic factors. This requires an in-depth study of the various socio-economic factors that act as indicators of the strength of an economy. It is these indicators which drive the price action and the strength and weakness of the currencies in the Forex markets. The various socio-economic factors can be broadly classified into the following three types. These are the economic factors, the financial factors, and the political factors. We will now be discussing the economic factors in detail in this video. Economic factors tend to have the biggest impact on a currency's movement due to the uncertainty it imparts to the nature of the economic data released. These factors help measure the economic strength and the sentiments which can affect the economy directly or indirectly. Economic data releases are the tools to measure the strength or weakness of an economy. Important data like the GDP or the gross domestic product figures, the unemployment situation, retail sales data are some of such indicators. While some economic indicators are critical and a change in those values may bring a major change in the price action of the currencies involved, some other releases may not be so critical. So how do we use these factors while trading? It is always a good practice to be well informed and have the proper knowledge about the products, which in our case are the currencies, that you are interested in trading. These include the various economic factors that we just mentioned. Study the factors to determine an expected value of the future performance or the expected future value of the various indicators such as GDP, employment data, jobless rate, retail sales figures, etc. And on the basis of these expected value, initiate trade positions to take advantage of the anticipated results. If the data release is in line with what was anticipated, then it should have already been priced in to the market beforehand, leaving no major price action. If, however, the result deviates away from the anticipated numbers in either direction, positively or negatively, then it will have a bigger impact on the market and the price action in the currencies involved. Some of the major and most widely tracked economic indicators are as follows: the GDP or the gross domestic product figures, the CPI, that is the consumer price index, which is the headline inflation number, the unemployment rate, retail sales figures, consumer confidence report, or the PMI reports for both manufacturing and services. We shall discuss each one of them in detail one by one. Starting with the GDP. GDP or the gross domestic product is one of the major economic indicators that generally reflects the state of the economy of the country in consideration. It is the market value of all the final goods and services produced within a country in a given period of time. An increase in this value or a better than expected figure is considered positive for the economy. The underlying currency is expected to strengthen against its major peers in case of a positive data, and alternatively, a decrease in this value could be negative for the economy, resulting in the weakening of the currency. In each of the scenario, the trader can position himself depending upon his expectation or his anticipation of the expected result. If he expects the result to be positive, he can go long on the currency in consideration, and if he expects the data to be negative or expects a worse figure than the previous one, then the trader can go short or sell the currency in consideration. Then we have the CPI, or the Consumer Price Index. This gives the measure of the inflation or deflation in the economy. It assesses the changes in the cost of living by measuring changes in the price of consumer items. It is the headline inflation figure indicating the strength of the domestic inflationary pressures by measuring the change in the purchasing power. High or rising inflation acts as a signal to the government to raise the interest rates, to encourage saving because of the high interest rates offered, and in turn help curb the inflationary pressures on the economy. A deflationary economy, on the other hand, would be a signal for the government to cut interest rates or ease its monetary policy by pumping out money into the economy to encourage growth. This increased money supply in the economy can cause the currency to weaken. The employment data of an economy is also an important indicator of the strength of the economy. There are various indicators to gauge the level of employment, such as the payroll data. As we all are aware, the US NFP, or the US non-farm payroll data, is the most widely tracked economic data release tracked by traders from all over the world, following its release on the first Friday of each month. We will, however, be discussing the importance of unemployment rate in general across all economies. Unemployment rate, in general terms, is the percentage of individuals in the labor force who are without a job but actively seeking one. A high unemployment figure causes the consumer spending to decline and is negative for an economy and could result in the weakening of the currency. A lower or decreasing unemployment rate is positive for the economy and can encourage consumer spending and economic growth, resulting the currency to strengthen. Next is the retail sales figures. Retail sales figure measure the change in the sales of the retail sector of an economy. It is an indicator of the consumption based on the domestic demand in the economy, expressed as a percentage change. A higher figure than the previous value indicates an increase in the consumption and spending and a growing economy. This is positive news, resulting in the strengthening of the currency, though exceptionally high values could cause inflationary pressures. A decrease in this figure would result in the weakening of the currency. Then we have the Consumer Confidence Report. This is again a very important indicator which often has medium or high impact on the price action in the currencies involved. The Consumer Confidence Report measures the consumer sentiment in the economy. The figure is based on consumer surveys about personal finance, the job market, the likelihood of household savings, and the consumer's expectation of the economy. Therefore, high levels of consumer confidence is good news for the economy, indicating that the consumers are more likely to increase their consumption, which would in turn spur growth, resulting in a stronger economy and a stronger currency. So a positive or a better than expected consumer confidence report results could be followed by an increased buying in the currency in consideration, and so a trader who anticipates an increase in this figure would ideally go long on this currency involved. Alternatively, lower consumer confidence level suggests decreased spending and a negative outlook for the economy and may cause the currency to weaken, causing a selling bias for the currency involved. And finally, we have the PMI, or the Purchasing Managers Index, for manufacturing and services. PMI manufacturing and services have a strong impact on the price action, as these indicators gauge the overall performance of the manufacturing and the service sector of the economy. It is a good indicator of the overall economic condition, and hence a positive or a high figure is considered good for the economy, causing the currency to strengthen, while a negative or lower figure can cause the currency to weaken. So traders who anticipate a better than expected PMI manufacturing and service data would go long on the currency in consideration, while a trader who anticipates a worse than expected data would go short on the currency in consideration. So this is how you can use these various economic indicators to position yourself while trading the associated currencies of the economy in question whose data is being released. These various factors affect the price action or the movement in the Forex markets. We will be covering the various financial and political factors in the next video in this series. Thank you again for taking the time to watch this video.